Welcome to the MyLawCLE presentation. During today's presentation, you may access the course materials from the handout section located on your screen. Attendees seeking credit for this presentation, pay careful attention to the screen. A pop-up box will be displayed at various times during the presentation. You will need to click Confirm on the pop-up each time it appears to qualify for CLE credit. In order to receive CLE credit, you must also click on the link that will appear at the end of this presentation to initiate the certificate process.
Hello everyone, and welcome to our presentation on premium financing and life insurance. And premium financing and life insurance has turned into a big hotbed area. We've got a lot of experience in it, and we're going to explain to you today how it works, what you should be looking for your own clients when they come to you and say, I've got this great deal I'm about to enter into, the red flags you should be looking for. And if they come to you too late and they're in a deal and it's blown up, you need to know, what do you do? What do you do if your client comes to you at that time? And our firm is the Quantum Law Group. I'm John Deere, and this is my partner, Peyman Cohan.
Good afternoon.
And we are a boutique firm in Beverly Hills, California. Peyman and I and our other partner, Stephen Morris, have been handling these premium finance cases for more than a decade. We've litigated them, we've tried them, and these are very complex cases, and we're going to help you to understand the whole lay of the land on that. You can see some of the other things our firm does here, but today we're going to be focusing on premium financing and life insurance and how your client can get stung and how those deals go wrong. So we'll start just by explaining how premium financing works in life insurance. So the purpose and origins of premium financing. So in the early days of insurance, it was cash on the barrelhead. There was no financing. There was nothing like that. In the mid-20th century, credit was becoming a little more popular, and insurance policies started splitting up your premiums, letting you pay it out over 12 months. Well, that eventually developed into some insurance companies actually loaning you money to pay the whole premium, and then eventually an entire industry built up around loaning money for premium financing, so that today it's a very substantial industry. There are specialized lenders that make these premium financing loans, and they're pretty well wired so that there's a lot of ways your clients can get stung, and we'll get into that as we go forward.
There are always legitimate uses of premium finance. A lot of times people need to have the insurance for estate planning purposes. However, they lack the liquidity at the time. So what they do is they reach out to a lender, and the lender comes and loans money to pay the premium on the life insurance policy. A lot of times the reason they do this because they want to lock in their insurability, and at some point in time they're going to come to a liquidity, whether it's a major inheritance or sale of an asset. Once they do that, then they can actually pay off the lender and have the policy free of any securities being given to the lender as collateral.
And what you're going to see later on in this presentation is that those kinds of applications that Peyman has just described those are the exception. So, part of what he's saying is you have somebody that's young enough to be highly insurable. They know they're going to come into a liquidity event later in their lives. So, for example, they're going to sell a business, they're going to get a big inheritance, something's going to happen later in life where they will have the liquidity to pay off those loans. But they want to get the insurance premiums locked in at a younger age because it's going to be a much lower premium for life. And by the way, in this premium finance world, typically we're talking about high net worth people, and we're talking about large amounts of insurance. And the insurance they may need, as Peyman mentioned, is could be for estate planning. Some people want an insurance policy to pay for taxes or for other reasons that they might need them. And so those are all legitimate ways to use premium financing. You look at it carefully. You look, is there a liquidity event coming up that's going to retire that loan? You would also look at, is the lender an appropriate lender? Is there a less expensive lender that might be more appropriate? So for example, premium finance lenders that specialize in it are pretty expensive because they're securing their loans in certain ways, and they're just expensive lenders. So you want to talk to your client, should you just take out a loan on your factory and buy that insurance? Is that a better option than this? So there are all kinds of things that come into play with legitimate uses of premium finance lending. And by the way, I meant to when I introduced Peyman before, I meant to tell you a little more about Peyman. So Peyman also works in the insurance industry. He's got more than 30 years of experience in the insurance industry, and about 12 years ago, when he was working with us, he started to identify to us these premium finance scams that we're going to talk about later, and trained us on how to understand these policies and how to understand what went wrong. And as a trial lawyer and a litigator, I looked at how can we get remedies for our clients. And so we put those skills together, and we've had a really good track record of going after these bad guys, and you're going to see how we do that later, and recovering for our clients who sometimes, we're talking about high net worth people, and sometimes we're talking about riches to rags stories. These plans are so insidious and so disruptive that they can turn somebody that's very wealthy into someone whose entire work that they've worked for their whole lives is threatened. So that's what we've worked out, and that's what we're presenting to you here today. So now, why has premium financing become now a frequent source of disputes and litigation? So your average high net worth person is very sophisticated in their own business, but life insurance is very difficult to understand. It's very difficult even for your smartest of clients to understand. It's something that takes training. It's beyond a layperson, and over time, unscrupulous agents, and this is not most agents, most life insurance agents aren't going to offer this kind of scam deal to your client, but plenty of insurance agents that are with legitimate agencies, but they drink the Kool-Aid and they think they can get away with this, have started pitching these deals that we're going to explain to you in a little bit. And they're deals that don't work, but they're very, very lucrative for the agents and the brokers. They're very lucrative. The kind of insurance they pitch with it pays very high commissions, much higher than legitimate insurance. And so they're through these plans are able to pump up the amount of insurance you get and earn just enormous commissions. So there's a real incentive to agents to be overly optimistic and try to share these things with try to pitch these things to your client. And then the other thing that's happened is in recent years, interest rates have gone up, and you'll see as we get a little deeper into it, that's a huge factor in making these deals crash sooner. So we'll get into that shortly. So yeah, go ahead.
So what are the features of life insurance premium finance? So what happens is lenders are there and they finance the premium of a very, very large life insurance policy. When they do that, obviously in return, they would want a collateral to be pledged as security for repayment of the loan. And the collateral is generally cash, marketable securities, in very, very rare occasions, real estate, and of course, the policy as collateral to the lender. So what happens is if they're loaning, let's assume $1 million on a premium finance deal to pay the premium of a policy, they're going to take the policy as collateral, because the way that some of these policies are structured, there's going to be some cash value in the policy. So the lenders obviously would want to have the policy as collateral, and then any shortfall of the cash value to the difference of what they have paid in premium, they would want as a security.
And that's going to be important later. We're teaching you these concepts about the premium finance world and how it works. And when we get to these deals that go wrong, all these concepts are going to be important. So the way collateral is pledged, what kind of collateral they take, all that's going to be important later. And then these loans are also, they have recourse. So they have recourse to the borrower. And you'll see that most of these premium finance companies want a loan to a company. So up above where it says premium financing, the lending of funds to a person or company to cover the cost of life insurance. Usually the lender wants you to set up a company. Either they want to do it through your actual company, or if you don't have a company, they want you to set up an LLC. And that's for, they want a bankruptcy remote entity basically. And so they have you set up an LLC and they pretend like they're loaning to a company. That's what they always do. They say, we loan, this is a commercial loan, we loan to a company. But basically they took a high net worth person and made them set up an LLC. So there's recourse to that borrower. So these are not non-recourse loans. If when the deal crashes, they're looking to recover from that entity. And go ahead.
And a lot of times, the individual members of this entity are going to be guarantors on the loan, meaning that obviously they're going to be guaranteeing the obligations of the company if there's a shortfall in cash. So if the agent or the broker has told the insured that no, you're not going to be personally liable, that is not the case. Every single transaction that we have seen, the borrower or the insured is definitely the guarantor on the loan.
And remember, the lender is not the one selling you the policy. They're just loaning you money. So they get you as a guarantor, and when you'll see later about some of the things that go wrong in these deals, it's usually not the lender's problem. So they have you as a guarantor, your client's guaranteed millions and millions in premiums. They've loaned on a lot of that, so they've actually dished out the money, and your client owes that money back if this deal goes south. Through either through collateral or as a guarantor, and we'll talk about that more as we go forward.
And a lot of times when it is shown with regards to what the premium is going to be and what the interest rate is going to be, whatever it's illustrated, they always illustrate that the interest rate is going to be fixed. It's very, very rare that the interest rate is going to be fixed. Most of the time, interest is variable. We're actually working on a case right now where the interest rate readjusts every month. So every month, the interest rate is different. And given the interest rate environment now, our client has faced a lot of challenges because whatever he has borrowed to pay the premium of the life insurance policies that has been placed on him, now he has to pay a lot more just to service the loan that he has borrowed to pay the premiums.
And you can see through all of this how expensive premium financing can be. It's an expensive way to go. So there are legitimate uses. There are times when it's worth it to take on all that cost, but it has to be analyzed in that context. If it's being pitched in a different way, and we'll see how it's usually pitched in these scam deals, it's ignoring the reality of it. Premium financing is an expensive way to buy life insurance, and it has obligations to you, including these collateral calls that we'll get to. And I just want to back up. Sorry, I'm just going to back up a little. We jumped over one of the concepts here. Okay, so another issue that becomes very important in these deals is the term of the loan. How long is this loan for? So life insurance premiums and may be payable for a long time. We'll go over the different various when we get into the life insurance, how life insurance premiums are paid and how long it takes. But there has to be some way to pay that loan back. So when the loan matures, whenever that date is, that loan has to be repaid. And so we'll talk about the ways that it can be repaid, but you've either got to come up with cash to pay off that loan, or you have to refinance it again. So those are more costs going into this deal, and then you have to service that new financing. And that new financing is going to have the old loan, which is all of the premiums that were paid, plus the freight of the new loan. So it gets more and more expensive over time. Okay, now we'll move forward here. And again, this isn't to chase you off of legitimate uses for premium financing. It's just to put premium financing in a context where if your clients come to you and want to be advised regarding it, you have open eyes and you know what you're looking at. And if the deal sounds easy and beautiful, it's probably a scam. Okay, so now we're going to talk about features of the insurance. And we're talking about the features of the insurance that are important to how these deals fail and also how these deals are represented. There are certain types of insurance that are commonly used in these scams, even though any kind of life insurance can be used. We've seen just about any life insurance product that's out there, we've seen used in these scams. But the typical one, Peyman's going to talk about
is
right
an
now.
Indexed universal life policy. We've seen variable universal life policies. We have, on certain occasions, have seen whole life policies, but although that has been very, very rare, mostly it's indexed universal life policies. And the way that the policy is designed is they illustrate where they say premium payments are paid over 5, 7, 10 or 20 pay, or sometimes lifetime, depending on how the policy has been designed. Obviously, if the policy is payable for 5 years, and that means the premium is payable for 5 years, you're going to be borrowing money for 5 years. If it's 7 years, it goes the same way. You're borrowing money for 7 years. What happens at the end of the 7 year? Where the policy is fully paid, but the loan is still outstanding on the books of the lender. So there has to be interest payments paid to service the loan that has been used to pay the premiums on the policy.
And let's back up a little and unpack some of what Peyman just described to us. So the most common policy that we've seen used in these scams is called the Indexed Universal Life Insurance Policy. And that's a policy that is theoretically indexed to some index, and we'll talk about what that index is later. It's usually presented as if it's key to securities, but it's not, and we'll talk in a few minutes what it is. But it's a policy that's supposed to grow cash value over its life. So you're paying premiums, and those premiums, a portion of it is actually invested, and the returns on that investment are theoretically going to grow cash value. And that growth in cash value is always part of the pitch in the scam. So that's a special kind of insurance, and we'll get more into it as we go forward. But you need to recognize that that indexed universal life insurance has some advantages for some people in certain circumstances, but it has some significant drawbacks that we'll talk about as we move forward here.
So as we're looking at cost of insurance on an indexed universal life policy, cost of insurance is not fixed. As you can see from the chart, the red signifies cost of insurance and blue is the premium payment that is being paid. So during the initial years, the premium that is being paid is more than what the cost of insurance is. So there's going to be some cash accumulation. When you reach to a certain point, cost of insurance is going to be significantly higher than the premium that is being paid. So the policy now is going to start using the cash that is built in it to supplement the premium payments because it's not sufficient to cover the cost of insurance. So that is how initially they show that there's going to be a lot of cash built up in the policy, but in later years, that cash is going to be used to offset the shortfall of premium that is being paid.
And so a way of looking at this is there's a when you pay a premium, there's a component of it that's called cost of insurance, and that component is theoretically what it costs the insurer to provide that insurance, because you have to remember throughout the course of this insurance, the insurer has to be ready to pay out if you get run over by a bus. So even if you're a young person, you could get run over by a bus. And so they're prepared to pay it out. There's an actual real cost to that. The insurance companies set that cost internally. They figure out, okay, what is our cost of insurance? So part of that premium you pay goes directly to what they call cost of insurance. And that amount of money increases over time. So your premium stays the same. They've given you a flat premium, and that cost of insurance increases. So The rest of the premium that you're paying supposedly is invested if it's one of these indexed universal life policies, and it's supposedly generating cash for you depending on its performance. And so as the cost of insurance goes up, there's less and less money to invest. And then when it crosses that line that Peyman just showed you, now that cash that's in your policy starts getting eaten away to make up the difference. So there's a point along the way where the policy is building, and then as the cost of insurance crosses that blue line, then it might start shrinking. So that's a feature of this kind of insurance. Okay, and that brings us right into crediting rates. So this insurance is often presented as if it's like, indexed to the securities market or something like that. What it's actually indexed to is an internal rate set by the insurance company themselves. It's called a crediting rate. And it's just an internal rate that they set to say, this is how much interest we're going to pay on this money that we're supposedly investing. So if there's cash that exceeds the cost of insurance, we will pay this crediting rate on that. So those are the basics of how this kind of life insurance works and how this kind of premium financing works. So you can see these are complex deals. They're not simple. They have collateral. The collateral's got to be cash or securities. You can't pledge your warehouse. You have all that equity locked up in your warehouse, but premium financiers rarely will accept that kind of collateral. And you can see that it's complicated because your policy has to perform in a certain way, and you also you're paying premiums every year. So the amount you're borrowing goes up every year. So these are complex deals, and they can be misused, and they are misused by these agents all the time. And so, and I want to be clear again, we've dealt with so many honest, decent agents that are looking for the correct product for their clients to meet their needs, to help their financial planning. So it's easy to say all insurance agents are trying to cheat us and stuff. It's definitely not the case. We deal with insurance agents day in and day out, and in fact, most of our cases come from insurance agents. They'll have a client come in and they'll look at it and go, you got ripped off, and they'll call us. So while we talk about certain kinds of agents that are willing to do this, it's the exception. It's like anybody committing scams, any criminal, any con man. They're the exception. Most people aren't doing that. So we just want to be clear on that as we're going forward, and not cast a broad brush on an industry. So now we're going to talk about the anatomy. So this is how these deals are pitched to people, and we'll tell you right now, it's a fraud. And so you're going to see the features of it, and then we're going to unpack those, and you're going to understand clearly how it's a fraud, and you can understand how someone who does not know life insurance, which is almost all of us, until Peyman taught us this, more than a decade ago, we didn't know it. As the litigators, we didn't know it. And you'll see how they can be convincing, but it's a scam. So here we go. So the first thing they present to you is they have a special opportunity for you to buy excessive amounts of life insurance, and we're usually talking to high net worth people, and so they're attracted to special opportunities. They're attracted to big numbers. So we have one case right now where they sold over $150 million in life insurance to our client, over $150 million. But sometimes it's way less. We've dealt with cases with 20 million, 10 million,
60 million.
60 million we've had in a case. So it's all over the map. It's whatever the agent thinks they can talk you into, honestly. It's whatever they think they can talk you into. So that's one of the features of the scam deal. They're convincing you that they can get you all this excessive amounts of life insurance.
They also talk about the fact that we're getting you all of this insurance. It's free. It's you're not coming out of pocket. It's cashless. We're using the bank's money. Why wouldn't you want to get this boatload of insurance for your family if it's free? If it's cashless insurance, there's nothing coming out of your pocket. They also say that once we do this for you, you're going to get substantial amount of retirement income for yourself and while you're alive, so you don't have to wait till see the benefits of the death benefit, which your family will see, obviously not the insured, but while you're alive, you're going to have significant amount of retirement income for life.
And how these things lock together, the free insurance is based on the idea that you're using the bank's money, you're using a lender's money, it's not costing you anything. You're taking out a loan, and one way or another, the insurance itself is going to repay that loan. That's part of an integral part of the pitch. And they pitch it in all these different ways. The insurance companies sometimes take steps to stop them from saying some of these things, but then they invent a new one that's equivalent. So, for example, the insurance company landed on agents for saying free insurance some years ago. So they switched to cashless and they switched to using the bank's money and euphemisms. But the whole idea is, I have a deal for you that doesn't cost you anything. That's the whole deal. And then as Peyman explained about the retirement income, what they're saying is this cash value is growing. This insurance is so big that the cash value is going to grow to spin off enough income so that even before your death, you're able to draw off that policy and have extra income. You'll be even richer than you are now. And by the way, we have seen this pitched to some middle-class people. We had one case where it was pitched to the owners of a hair salon, and they bought it. And it was particularly gross because those are people that are just wiped out for life on a deal like this, right away, wiped out for life. But it's typically high net worth people that are the targets. So it's your high net worth clients, very smart people. They're just sucked in by slick agents that understand that they don't know life insurance.
What they also say is that there's little or no out of pockets. There's going to be a one-time collateral, which will be released very soon as the policy is placed in force shortly thereafter. Well, generally, that is really not the case, because what happens is when premium is paid and the policy builds some cash, much less in the early years, there is going to be a shortfall. So as the second year's premium comes around and it's paid, obviously the lender is putting in more money. Now there's going to be more shortfall. So there has to be additional collateral calls. And we have seen where our clients have been told, you should definitely do this additional collateral call as well, because if you don't, you're going to lose out on the money you paid. No, you just have to pay it. Trust us, this is going to work really well. Put the collateral, the money is there, it's all yours. You can use it anytime you want. But what they don't say is actually that is not the case. The account, marketable securities or cash is used as collateral, and the lender holds it, and the lender controls it, and the insured or the person who's borrowed has no access or use to this collateral.
And we've seen, in the cases we've handled, we've seen every misrepresentation that you can imagine, and particularly in the area of collateral. Usually the insured that buys into this deal, the borrower, has no idea that they have to put up money year after year. And they're told you just put it up once and that's it. They're told that all the time. And then the agents make an excuse for the second year. Oh, we suspected it might have a shortfall the second year, but just do it. It's going to grow next year and you'll get your collateral back. And then the third year, they try to come up with some excuse. And as this deal's crashing, that's when we see the client. After they got lied to 3 times, they get that they're just being lied to. So the collateral is a big part of how these deals fail, and we'll go into that later as well. So there are also, in almost every deal, they're told there's no personal liability. There's no personal liability. And as an attorney sitting here, you think, well, how can a client sign a guarantee and think there's no personal liability? And we'll get into how they orchestrate that in a little bit. There's typical the way the documentation is orchestrated, but they're told, there's no risk here, because if it goes bad, they'll just take the policy and liquidate the loan, and you've got no risk. Completely untrue. First of all, you've got massive amounts of your collateral tied up. Second of all, the loans almost always outstrip the collateral so that you've got additional liability beyond your collateral. But that's part of the pitch, no personal liability.
One of the other pitches that they give, they say, oh, don't worry, once you pass away, the lender is paid back. Well, what happens if you're dealing with a very young insured? And in our case that we have in our office right now, when our client was sold this particular premium finance policy of $150 million, he was 30 years old. And he was told that, well, once you die, the lender will get paid. Well, he's 30 years old. His life expectancy is at least for another 40, 50 years. So basically what the agent has told him is this loan will stay on the books for 30, 40, 50 years. And at that time, the lender will get their money. Well, for 30, 40, 50 years, interest has to be paid on the sums that have been borrowed. And every year as premium payments are paid, the payments get more expensive. And there was a point in time that our client was paying over $250,000 a month just to service the loan on the funds that he had borrowed to finance the premium.
And so, so these expectations that are created are completely unrealistic. And if you hear a deal that sounds anything like this, as an attorney, you need to tell your client to run away. It sounds, when you hear us explain it this way, it sounds obvious. It's like, who would believe any of this? Who would believe any of this? Well, it's not obvious to your clients. The person pitching it is very slick. We've seen it come from trusted insurance agents that have been with somebody for 20 years. They get sucked in by a co-agent who pitches them on this baloney, and they see gold because the commissions are so high, and so they stick their head in the sand and present it to their own clients. It can come to your client in many, many different ways. And when it comes to your client and they're thinking, wow, it's good to be rich because I have an opportunity like this, it's your job to bring them back to the ground if they're smart enough to talk to you about it. So now we're going to talk about where the deals go wrong. You're getting a sense of it already just by the way we're describing it to you. But these deals have pressure points, and they always collapse. They don't work. They always collapse. And so one of the key things that happens is interest rates on the financing. So especially now, and that's part of why there's a lot more cases now than when we first started. One of the reasons is interest rates have gone up, and these are all variable rate loans. And when the interest rate goes up, the lender is demanding more collateral, and so they demand collateral every year. So if the interest rate goes up, it's more expensive to carry that loan. And from a sensitivity analysis standpoint, you can see if you have a $100,000 premium the first year, and a lot of these premiums are much higher than that, but I'm just using that as an example. They're typically could be in the millions, but 100,000 the first year. The second year, you got 200,000 worth of premium that you've now borrowed. The third year, 300,000 worth of premium. And so if the interest rate goes up, that's a huge difference in your carry and what you have to carry. And that keeps going for the life of that loan. So an extreme sensitivity to interest rates is one of the reasons these deals go wrong.
And as John said, when every year premium payments are paid, obviously, then you're borrowing more from the lender. And if the interest rates go up, then the servicing of these loans get more expensive. We have also seen cases where our clients have been pitched where they don't even pay the interest out of pocket, and the interest accrues on the loan. So therefore, now you have, let's assume, policy has been enforced for 2-3 years. Now 3 years funds are borrowed. Interest is accrued for 3 years. Now what happens is there are collateral calls. They say, listen, the amount of cash in the policy is not sufficient. Premium payments have been paid or more. The interest rate has accrued. Therefore, there's going to be additional collateral call, which is most likely 9 out of 10 times is cash. On rare occasions, they say, okay, transfer your your securities account or your retirement account to us. We'll take that as collateral, but 9 out of 10 times we've seen that it's actually cash or brokerage accounts.
And for your high net worth clients, this drain on their cash flow quickly gets to be too much. I mean, we've had very wealthy people that just cannot meet this burden. In fact, most of our clients are that. They're very wealthy people, but there's no way to meet the burden of this ballooning debt that they've agreed to. Another factor is maturity of the loan. The typical loan that we see is 5 years. Well, the typical pay on the policy is more than 5 years. And not only that, even if it's a 5 pay, that means after you pay 5 premiums, you're covered for life. Even if that's the last premium you have to pay, you have this big loan out. So it matures. So what do you do there? Now you have to re-up it. And that we have yet to see that ever having been explained to any client in any of these cases, that they have to go get a new loan after that loan matures, that it's not taken care of. It's not part of the deal. And again, they're at the mercy of lenders. They have to go to the premium finance lenders, and they can charge them anything. They don't have a bailout. So it's a trap. These kind of deals are a big, big trap.
And we have seen when this is illustrated to our clients, there is a beautiful spreadsheet that is prepared by the agent that shows the loan on the books for 10, 20, 30 years. And one of the ways they do it, they say, okay, we have placed a policy for you that you pay for it for 7 years. That means you're borrowing money from the lender for 7 years. Let that be on the books, and then we'll take the cash out of the policy in year 15 and pay the lender off. And then now you have this policy that is free and clear, that you now have your quote unquote free insurance or cashless insurance. And what they don't illustrate is the rate is never fixed, and the loan will never be for a term of 15 years or 20 years. And it's always for a much, much shorter period of time.
And let's take a minute to talk about insurance illustrations. That's something we haven't talked about yet. So an insurance illustration is a thick document, could be 100 pages thick, that theoretically explains to your lay client who knows nothing about life insurance what they're potentially getting. And it supposedly explains the policy to them. Nobody that's not trained in insurance can understand an insurance illustration. Nobody. It's very complex. In the middle of that illustration, there's a specific chart, and it's in the middle of every one. Every insurance carrier does them differently, but it takes certain assumptions and it lays out this is how the policy could perform if these assumptions happen. And the assumptions are dictated by the agent. The insurance company doesn't have a standard illustration that it sends out. The agent says, I want you to illustrate it under X, Y, and Z assumption. And the insurance company does that. This is created under these assumptions. And so it's, in the first place, it's a very complex document and chart that your average person can't understand. But second of all, it can be manipulated by the agent to show any performance, to show literally any performance they want. And it does. So they give you a song and dance about how it's going to perform just as Peyman described. And that's not the way it happens. That's not the way it happens ever. So now, one of the key concepts that we talked about before relates to crediting rates. So crediting rates is the rate that the insurance carrier says that extra money that you've paid in your premium is going to earn interest. And the illustrations typically show it flat over the whole period of the policy, and that's not the way crediting rates work. And this is a chart we took from the website. I just took it 2 days ago from the website of a major carrier, and it shows, if you look at it, it shows for each of their products that crediting rate goes down. Crediting rate goes down on the second one. Crediting rate goes down on the third one. There's one of them in there where it stays even for about 3 years, but it's only projected out for 3 years. So inevitably, going forward, the crediting rate is going to go down later. And so,
by the way, this particular crediting rate applies mostly to index universal life policies. That's why a lot of times agents use index policies, because they show these crediting rates and it works better as they're illustrating for premium finance.
Right, right. So it's easier to manipulate and make it appear that it's going to have all very rosy growth. And so one of the problems with these deals is that the illustrations are rosy, they're unrealistic, and that the deal could not perform as illustrated no matter what. It's going to collapse at some point. And you have to imagine that if you could really just borrow money and make a whole ton back automatically, everyone would do it. Everyone would do it. So the fact that everyone doesn't do it tells you that that's not really realistic. That's not what's happening here.
So where the deals could also go wrong is where we talked about cost of insurance on index universal life policies or variable universal life policies, or for any index policy for that. Cost of insurance is not guaranteed. So as the insured gets older, cost of insurance goes higher. So sometimes the premium that is being paid is not sufficient to carry the policy forward. And we have seen in certain circumstances where our clients get a letter from the insurance carrier saying that in order for you to keep the policy death benefit at this amount, you will need to either pay higher premium. If you want to continue paying the same premium, then we're going to reduce the policy death benefit to a lower amount, because cost of insurance on this particular product is not guaranteed.
And we had one case where the cost of insurance went up 80%. And in that case, we got into litigation with the carrier. That's a little different than the premium finance cases, but we got into litigation with the carrier over the cost of insurance and litigated whether it was legal to raise it that way. And that issue with that carrier turned into a national class action where they got hammered for that kind of a raise. But they determined the cost of insurance. So one of the sensitivities, and that's why these deals, if you stress test them at all, you can see there's a million ways they blow up. And the cost of insurance is another one. And then finally, we'll get back to what we talked about earlier, which is personal guarantee. These deals have a personal guarantee always. We've never seen one without a personal guarantee. And in most of them, the clients, the insured, did not realize there was a personal guarantee. They were told there wasn't one. And the amount of the loan generally outstrips the collateral and the value of the policy. So when it blows up, the lender seizes the life insurance policy, and then they typically surrender it and take whatever surrender value there is, which is often less than the cash value. They take that surrender value, apply it to the loan. They take all of your collateral, apply it to the loan, and there's still substantial balances left even after you've lost all your money and you've lost your policy. And by the way, a piece of collateral damage from that is you now don't have a life insurance policy also. So whatever planning you were doing as an insured, the reasons you needed a policy are gone, because you can't, you're older and it's much tougher to get life insurance. So now your deal blew up, you've lost a huge amount of money, and you can't get insured. So your tax planning that you did is out the window. So let's just back up, and then we're going to go into who do you sue. But before you get to who do you sue, we just want to sort of regroup here a little bit and talk about, so when your client comes in and wants you to evaluate this deal, what do you do? So the first thing is you look for all these red flags, and if you see them, you tell your client to run. And if your client's going to listen to you, great. If they're not, you find somebody experienced in this area of litigation, whatever you have to do to get your client away from that deal. And if it's too late and they've been in that deal for a few years and they come to you and go, what do I do? I'm sinking here. We're going to talk to you about that right now. So it takes litigation. So in the early days, we tried to contact the carriers and the brokers, and we tried to work out deals with them. They have a million excuses, and we'll get into that shortly. And there's no working it out with these people. They're wired for this. The lenders are wired for this. They've experienced this a million times, and they defend hard. And every one of these cases we've had to fight through. We've recovered in every single one we brought, and it's been a battle in every single case. So prepare yourself for real litigation when you do this. So who do you sue? So obviously you sue the agent and the broker. They're the ones that made the misrepresentations. They're the ones that actually sat with your client and convinced them in all this cock and bull. Convinced them this is a good deal for you. You're a wealthy person. You're special. You have this special deal for you. So you sue them. The carriers, we also sue the carriers. In every one of them, we sue the carrier. And the reason we sue the carrier will always say, I just provided insurance. But the carriers have guidelines. The carriers know this scam. This is not it's something that was just invented yesterday. And they have guidelines internally that are supposed to ferret this out. And in every case, they look the other way. In every case, they look the other way. It's a huge sale for them. And they come up with reasons why they get around their own guardrails. And so we look for that in these cases, and we sue the carriers too. So the carrier's sitting at the table in the litigation, and they're sitting at the table when it comes time to settle. And if they don't settle, they're sitting at the table in a trial.
A lot of times the agent also acts on behalf of the carrier if they're a captive agent for that particular insurance company. So they're not necessarily a broker, so they represent the insurance company. So their actions really is really actions of the carrier. So a lot of times they are also on the hook because of the actions of the agent.
And that's exactly right. And we've looked at licensing and all kinds of other things to see whether the carrier arranged for the license. So it's different state to state, but in some states, the carrier actually has to take steps to get the agent licensed to be representing that carrier in that state, and it makes them the agent of the carrier. The lender, do you sue the lender? Now this is a tougher question, and so there's no question that the lenders know what's going on. These are specialized premium finance lenders. There's no question that they understand these borrowers are in way over their heads when they make the loan, but they are wired very well to withstand liability. And depending on what state they're in, and they're usually not in the state that the borrower's in, and the loan documentation puts you in their jurisdiction, we have not had great success against the lenders. And we've discovered over time, much better to work with the lender. So you're working with the lender to get your client through this, so you're not fighting with the lender, you're not running up default fees, you're not running up attorney's fees that the lender's also going to want to collect. You're minimizing the damage typically with the lender. Now, I'm not saying that we won't discover in the very next deal some smoking gun that helps us actually go after the lender, but it's been more advantageous to our clients not to fight with the lender, to work out deals with the lender, to compromise where we can, work out time if we need it to get through the litigation, whatever we can do to work with the lender to help your client through this mess while you're recovering from the other parties. So, what are the causes of action? How are we doing on time? We're doing perfect. Okay. So what are the causes of action that you have against these parties? So the first one, and the one you're looking for because it anchors everything, is fraud. And fraud's important for a number of reasons. Fraud's important because when we get into defenses, you're going to see that there are defenses to a normal transaction. If this was an arm's length transaction and was not fraud, just because it's a terrible, terrible deal, nobody's liable for that. Nobody's liable. Your clients are usually very sophisticated people. So absent fraud, you have a problem. So we're always looking for fraud. That's the starting point that we look for. And then obviously negligence is just a lesser degree of fraud, but if you don't have those opportunities to find fraud, then the whole thing's much weaker. So you're looking for fraud, but you always plead negligence with it in case the jury, if you get in front of a jury, they don't think it was intentional, they think it was sloppy or something. But fraud is your key. You always want to bring a rescission claim, and these are complicated and tricky because you have multiple parties. but you want to rescind the policies because you want all your money back. That's what you're after. You want all your money back. So you bring a rescission claim along with the other claims. And then breach of fiduciary duty. And so now, breach of fiduciary duty is a little more complex, and you have to look at the circumstances. We've brought it successfully in a number of these. So breach of fiduciary duty comes up where the agent is holding itself out as a financial planner, where they're pitching themselves as the expert, where their role in it is something extraordinary beyond I'm an insurance agent and I want to sell you insurance. We find it all over the place, though. We found it, we find a lot of the insurance agencies and brokerages hold themselves out as financial planners as opposed to just insurance agents. And so if a client comes in and says, I need financial planning, and they say, we have a plan for you, let us put it together and we'll show you this plan. They're your fiduciary. They're your fiduciary. We've gotten it to stick repeatedly. They've held themselves out in an expertise beyond the role of agent. If they're just an agent, you have battles over whose agent they are, what duties they have. An agent's duty is really just to get you the policy you ask for. So they're minimal duties. But it's when they step beyond that role that they start having additional duties. And then there are statutory claims. So in every jurisdiction, you need to look at the specific statutes that might also offer protection. In California, we use Business Code 17200, which is an unfair competition statute, and it's wherever somebody sells you a product or service through misrepresentations and other bad acts, you have a remedy there, and that remedy is disgorgement of the monies that they've taken from you. And then on top of that, sometimes you can add attorney's fees in the right circumstances under another statute. We brought litigation in New Jersey where we found different statutes that go directly to insurance. We brought claims in Tennessee where we found some statutes that are applicable. I'm trying to think what other jurisdictions, but whatever jurisdiction you are, you need to look at what statutes might be applicable to misuse of insurance, and you want to add those statutory claims. They're very, very powerful claims. So now let's talk about the insurer's defenses, and these are tough, complicated cases where the insurer raises some powerful defenses, and so you have to be prepared to look at, okay, how are we going to get through this defense? And that's why these are a brawl, because they have a lot to play with here. And their number one defense is disclosure of risks. So typically in these deals, your client is presented a mountain of paper, and usually it's in connection with the loan component of it. And somewhere in there, they initialed a page that said, all these risks we just told you about. It lists them and tells them, this is a risk, this is a risk, this is a risk, this is a risk. And we've had them initial it. Sometimes they sign it at the bottom of the page. And how do you get around that? Your client was told. Well, we have a number of strategies. The first part of that equation is if you actually saw that, you would never, ever, ever, ever enter into that deal. If you actually understood those risks, you'd run away. So we already know they didn't understand those risks. So then the question becomes, okay, why? Why? And the argument from the insurer's side of it, lazy, you didn't read, you just signed stuff. So we have to look at the circumstances under which the documents were executed. And it's always a similar story. The agents always create urgency. It's not like they send you a packet of documents and say, read this for a week. They always create a sense of urgency. We got to close this tomorrow if you want this deal. It's going to slip away. We had one where they took the insured to a restaurant, sat down, they're watching a game, and he holds out the signature lines and holds the papers the whole time. Sign here, sign here, sign here. And so we're looking for that. That's going to be an important component of this fraud. What were the circumstances? And you have to dig deeply. You've got to talk to your client. They often don't remember. And you have to understand, how did they come to sign a document that says they understand all these risks? We have yet to lose one based on that document. But you've got to dig deeply and figure out what happened, and has to be real, and you have to understand it well to be able to throw it at the court, because they're trying to get rid of you in summary judgment, in motions to dismiss, in whatever stage they can.
One of the things that they also do, they come back and say, well, if you would have stayed in the plan for another 3, 4, 5 years, this would have worked. No, it would not work, because once again, there's always shortfall on collateral and the interest rates have increased. So therefore, there has to be more out of pocket, and the client, a lot of times, especially our high net worth clients, can't even afford to service the loan, let alone continuing it for another 3, 4, 5 years. They're gonna go belly up themselves. They're not gonna have the liquidity and the ability to pay the additional interest payments.
And in addition, so when they say the plan would work if the insured stayed in, they always talk a good game. They're always showing some scenario where if you just done this and this and this, like we told you, you would have been rich. The plans don't work. If you have to have the expertise to understand the plan, or you have to hire an expert to understand. You have to understand why it would collapse, because they'll go to their grave saying that it would have worked. They don't work. They don't work. They would collapse on their own. If your client put 2 more years of money in, that's 2 more years of wasted money, 2 more years of premiums that will never get them anything. The performance on these plans can't work. If it could, we'd all be doing it. We'd all be putting up collateral, and our children would be getting rich. It doesn't work. So you have to have the expertise, or hire the expertise to dig in and be able to return their discussion to them when they tell you it would work.
And lastly, cost of insurance as a defense. They come back and say, well, during the time that this policy was in force, you were insured. If something were to happen, we would have to pay the death benefit or the claim. So in that sense, not a problem. Cost of insurance as an offset would be very limited, because it's term insurance on the insured for 2, 3, 4 years, 5 years, which is very nominal in respect to the premiums that are being paid for the actual policy.
So in other words, what we do to counter, so there is a real cost of insurance on one of these universal life policies. And what we do to counter it is we say they didn't need a universal life policy. That was part of the scam, was selling them that policy, that very sensitive policy that could not perform the way it was represented. To have life insurance, all they needed was a term policy. That's your most basic life insurance. You can be insured till 70, and then the insurance evaporates.
1 minute.
Oh yeah, okay. And so that premium is really low. So we counter with, okay, here's the real cost of insurance. Okay, so let us just summarize. We are in our last minute here. So just to summarize, what we're talking about here today are life insurance premium finance scams. These are very insidious scams that can change your client's fortunes. Your client's a high net worth client. They're doing great in life. They're loving their life. They believe they're special people because they become wealthy. And now they've just been taken in a scam that can change their fortunes. So, and then we talked about the features of the scam. And it's a deal that when we step back in this context, it's too good to be true. It couldn't be true. But they sell it well, and it often comes from a trusted person. And so you have to be able to show your client why they shouldn't trust this person that they've been expecting to trust. An important feature of this is death is not an exit strategy. That's a really important concept.
Correct.
They always say the loan gets paid back when you die, but we see the loan matures early. The policy's not going to make it that long. The amount of money you'd have to pay to get to death to maintain that loan, exorbitant. It doesn't work. Death is never an exit strategy for premium financing.
We're coming down to the last 5 seconds.
Okay.
So
thank you
so much.
As stated during the beginning of this presentation, the link to initiate the certificate process will be displayed momentarily. MyLawCLE would like to thank you for your participation in today's presentation.